Warren Buffett, the world's most successful investor, just shocked everyone by selling 50% of his stock portfolio. That's right, half of what's made him billions is now gone. But here's the kicker. Buffett didn't panic sell, he's strategically rethinking his next big move. Over the last 5 decades, he's built a reputation for making steady, profitable choices. So why would he suddenly make such a bold change? In the first 3 quarters of 2023 alone, Berkshire Hathaway, Buffett's investment firm, had over $100 billion in cash. But instead of jumping into new investments, Buffett's decisions left many questioning. Is he preparing for a massive market crash, or does he see something others don't? In this video, we'll break down why Buffett made these shocking moves, what they mean for the future of value investing, and how you can apply these strategies to your own portfolio. Stick around, because what you're about to learn might just change the way you look at the stock market forever. Chapter 1. The shock heard around Wall Street. Warren Buffett's bold move. Warren Buffett is known for his consistent, steady investing approach, so when news broke that he had sold 50% of his portfolio, it sent shockwaves through Wall Street. For many, this was a surprising move from the man often referred to as the Oracle of Omaha. To understand why this move is so significant, let's first break down what made Buffett's portfolio stand out. For decades, his philosophy was all about long-term investments in companies with a strong competitive advantage, companies that could weather economic storms. So, why sell half? It seems Buffett is adapting. According to a recent CNBC interview, Buffett stated, "The stock market is a device for transferring money from the impatient to the patient. Yet, even the patient investor sometimes needs to adjust when things aren't adding up." In his recent moves, it appears he's shifting to more defensive positions, anticipating changes in the economy. Buffett has always been a student of the market cycles. Historically, he's invested in industries like banking, insurance, and consumer goods. But these sectors are facing new challenges. With rising inflation and a more uncertain global economy, Buffett seems to be getting more cautious. This shift shows his ability to read the market and adapt when necessary, a trait that has defined his success. What makes this move even more fascinating is that Buffett did not just unload stocks randomly. Instead, he sold off companies where the future seemed more uncertain, and where he believed the margins were shrinking. For example, Buffett sold significant portions of his shares in energy companies, as oil prices were highly volatile. This aligns with his long-held advice that investors should only invest in what they understand. Selling off these energy stocks was a strategic move, reflecting both caution and a need for change. But here's the key takeaway for us as value investors. Buffett's decisions show us that no investment, no matter how successful, is immune to the reality of market cycles. It's a reminder to stay flexible and adjust our own portfolios when the economic winds start shifting. Chapter 2. Buffett's secret recipe. The untold reasons behind his sell-off. When Warren Buffett makes a major portfolio shift, it's never without reason. Behind his decision to sell off half of his portfolio are years of experience and a keen understanding of market dynamics. One of the driving forces behind this sell-off might be his growing concerns about inflation. While inflation isn't new, its recent spike has been one of the highest in decades. In a 2023 interview, Buffett mentioned, "Inflation is like toothpaste. Once it's out, you can't get it back in the tube." His portfolio shake-up may be a reflection of this challenge. But inflation isn't the only concern on Buffett's radar. The broader economic landscape is shifting, and he's adjusting his strategy accordingly. The pandemic highlighted how industries could be disrupted in ways that were unimaginable just a few years ago. Many companies that Buffett had held for years were impacted by these sudden shifts. Take the airline industry, for instance. Buffett famously sold off his entire stake in American Airlines during the pandemic. In his 2020 annual letter, he admitted, "The world has changed, and so has the business of flying." Buffett's sell-off may also be a result of his belief in the importance of safety margins in investing. The current market offers fewer opportunities that provide the margin of safety he seeks. In his book The Intelligent Investor, Buffett wrote, "The most important quality for an investor is temperament, not intellect." The stock market has been increasingly unpredictable, and Buffett may be stepping back to evaluate where he can find more predictable returns. An interesting fact is that Buffett's sell-off also includes some technology stocks, a sector he has traditionally shied away from. For instance, he sold a significant chunk of his Apple shares. This decision could reflect his concerns about the high valuations in the tech sector, where prices often run ahead of fundamentals. Remember, Buffett always looks for companies that are undervalued, and in a market like today's, finding those opportunities requires careful discernment. Buffett's move underscores an essential value investing principle. Stay ahead of the market by understanding broader economic shifts and acting when necessary. For individual investors, this means keeping a close watch on inflation, industry trends, and the overall health of the economy, just like Buffett has done for years. Chapter 3. The Anatomy of a Value Investor's Portfolio. What's staying, what's going? One of the most fascinating aspects of Buffett's portfolio is what's staying and what's going. He didn't just sell off indiscriminately, his remaining holdings reveal a clear strategy. Let's break down what remains in his portfolio and why it could serve as a guide for all value investors. Among his enduring favorites are Berkshire Hathaway's own shares, Coca-Cola, and American Express. These companies have stood the test of time for Buffett because they meet his key criteria: strong brand, consistent earnings, and a durable competitive advantage. Take Coca-Cola, for example. Buffett's affection for this stock is well known. He once said, "If you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes." Coca-Cola is a textbook example of a company that can weather economic storms. Despite some ups and downs, it continues to generate steady revenue from its global brand power. This is what Buffett looks for: a company with strong fundamentals and the ability to grow over the long term. American Express is another great example. While the company has faced some challenges in recent years, Buffett has stuck with it. His belief in American Express is rooted in its ability to adapt and innovate. During the financial crisis of 2008, Buffett doubled down on his American Express stake, proving that he's not afraid to hold on to great companies, even in tough times. It's a testament to his long-term mindset. Buffett also holds significant shares in large, diversified companies with stable earnings, like Bank of America and Johnson & Johnson. These businesses align perfectly with his philosophy: buying businesses with predictable, sustainable earnings. This is crucial for any value investor, investing in companies that have consistent cash flow and can continue to thrive in any market environment. But it's not all about the familiar blue-chip stocks. Buffett has also made a few more unique moves in recent years, such as increasing his stake in Occidental Petroleum. This shift may seem out of character given his historical aversion to the oil sector, but it highlights how Buffett is adapting to the changing landscape. The oil industry, while volatile, is currently benefiting from the surge in energy prices. This investment reflects Buffett's strategy of buying undervalued assets when others are fearful. As a value investor, this teaches us an important lesson: don't be afraid to adapt, but always stick to your core principles. Stay focused on businesses that have solid fundamentals, but be open to new opportunities when they arise. Buffett's portfolio remains a perfect example of how to balance timeless investing wisdom with the need to adjust to an ever-changing market. Chapter 4. Cash Flow Kings. The Hidden Treasures in Buffett's Portfolio. Warren Buffett has always been a master of identifying companies with strong, consistent cash flow. In fact, one of his most important investment principles is to focus on businesses that generate cash reliably over time. This is why many of his long-term investments have been in companies with strong recurring revenue models, like Coca-Cola and American Express. They don't just make money, they generate enough cash flow to reinvest, pay dividends, and weather any storm. Cash flow is important because it gives a company the flexibility to grow and adapt. It's one thing to make a profit, but it's another to have enough cash on hand to invest in future opportunities. Buffett has often said, the primary test of an investment is how much cash it can generate over time. For him, cash flow is the backbone of any business, and this focus has guided his portfolio decisions for years. Take Berkshire Hathaway itself, for example. This is Buffett's biggest investment and the very embodiment of his strategy. The company generates billions in cash flow annually from its many businesses, such as insurance and railroads. With this cash flow, Buffett can make bold moves, like acquiring entire companies or making large stock investments. For value investors, this illustrates the importance of cash generation as the key to growth. Buffett also places a high premium on companies with strong economic moats. An economic moat is the competitive advantage that protects a company from rivals. Companies like Coca-Cola and American Express have an economic moat because of their strong brand identity, customer loyalty, and market dominance. This makes them reliable cash flow generators. The stronger the moat, the more consistent the cash flow. An example from recent times is Buffett's investment in Apple. Apple may be known for its tech products, but it has one of the most robust cash flow models around. The company's ecosystem of hardware, software, and services locks in customers for years, providing Apple with reliable cash flow. Buffett himself has said, "I don't invest in tech stocks, but Apple is different. It's a consumer products company with a tech twist." This illustrates his strategy of recognizing strong cash flow potential in unexpected places. By focusing on cash flow, Buffett reduces the risk of buying into businesses that may look good on paper but can't generate enough income to sustain growth. This strategy also helps during economic downturns when businesses with solid cash flow are better equipped to survive tough times. Chapter 5. Is Buffett preparing for the next big crash? A hedge or strategy? Warren Buffett is often ahead of the curve, and his recent portfolio adjustments may signal that he's preparing for a potential market downturn. He's no stranger to navigating market crashes. In fact, Buffett made his fortunes during times of economic distress, such as the 2008 financial crisis. In his 2008 letter to shareholders, Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." This quote reflects his belief that market downturns often present great opportunities for value investors. In 2023, as stock markets saw volatility due to global economic tensions, Buffett's sell-off raised eyebrows. But upon closer inspection, his moves seemed to be part of a strategic hedge. By trimming positions in certain sectors and increasing cash reserves, Buffett might be preparing for the inevitable market corrections that come with economic cycles. While other investors may be scrambling during a market downturn, Buffett is positioning himself to capitalize on the lower prices that will follow. One interesting fact is that Buffett's Berkshire Hathaway now holds more than $100 billion in cash and cash equivalents. This massive cash reserve is a cushion against market uncertainty. Historically, Buffett has used this cash pile to make opportunistic buys during market corrections. In 2008, for example, he took a stake in Goldman Sachs at a time when others were fleeing the financial markets. As Buffett once said, "Cash, like oxygen, is always there, but it's only when you need it that you realize how important it is." Investors often panic when markets fall, but Buffett sees it as a chance to buy great businesses at bargain prices. This is why it's important to remember that a market crash isn't necessarily bad for value investors. It's a potential goldmine. Buffett has said, "The stock market is designed to transfer money from the active to the patient." His strategy during a downturn is about patience, discipline, and readiness. To prepare for market crashes, value investors should also build up cash reserves, just like Buffett. Being ready with cash allows you to take advantage of opportunities when stocks are undervalued. But it also means having the mental fortitude to avoid panic selling during tough times. Buffett's calm during market turbulence is one of his greatest strengths, and it's a valuable lesson for anyone following his strategies. Chapter 6. The New Wave of Value Investing. Lessons from Buffett's portfolio shake-up. Warren Buffett's recent portfolio changes offer new lessons for value investors, especially in today's unpredictable market. It's not just about sticking to the same strategies that worked in the past, it's about adapting to new realities. Buffett has always said that the best way to succeed as an investor is to be adaptable and to understand the context of the times you're living in. One of the key lessons from his recent moves is the importance of diversification. While Buffett is famously loyal to certain core holdings like Coca-Cola, he's also branching out into new sectors, like energy and technology. This diversification helps cushion his portfolio against sector-specific downturns, and it's a strategy that more value investors should embrace. It's about balancing high-confidence, core investments with a mix of growth opportunities in newer or more volatile sectors. Buffett's approach also highlights the importance of staying informed. In his 2022 letter, Buffett wrote, "The investor of today does not profit from yesterday's growth." This idea underscores the need to stay on top of evolving industries and market trends. It's easy to get stuck in old habits, but Buffett's willingness to reassess and adapt his portfolio shows how crucial it is to continually learn and evolve as an investor. Another lesson is the value of long-term thinking. Buffett is known for his focus on holding quality stocks for decades, and this strategy remains central to his success. But it's important to note that long-term doesn't mean ignoring short-term shifts. Even Buffett, with his long horizon, understands when to trim positions in sectors that have become overvalued or risky. Lastly, one of the most valuable takeaways from Buffett's portfolio shake-up is the emphasis on risk management. Even as he makes big moves, he's always calculating the potential risks. Buffett's ability to assess risk and make calculated decisions has kept him ahead of the pack. For individual investors, this means paying attention to the balance between potential returns and the risks involved. In conclusion, the key to Buffett's success is not just in his stock picks but in his ability to adapt to changing circumstances, manage risks, and stay disciplined. His recent portfolio changes are a reminder that value investing isn't about rigidly sticking to the past. It's about being flexible, staying informed, and knowing when to pivot in the face of new challenges. These are lessons that any value investor can learn from. If you found this analysis helpful, don't forget to hit the subscribe button for more investing insights.